So you're saying that if you own the land under a tower, that you have upside optionality to perhaps add assets to that footprint?
Yeah, so traditionally, a tower sits on a block of land and the tower leases that land from somebody. Well, as technologies advance, there are several things you can do. You can bring backup power and lease it to the carrier, and all of a sudden you got an income stream. You can put in green power. There's actually miniaturized solar, miniaturized wind, believe it or not. You can bring batteries to become redundancy. So now you got another revenue stream from that land location. You can actually put some compute, some edge compute there, a little box, and folks have been testing the little box. Just having one piece of land isn't going to help you, right? Because how are you going to, there's 200,000 locations, how are you going to get any attention from that one piece of land? So having a meaningful network and a meaningful critical mass so that you can actually help in deployment is important. So that's partly what we're doing is we're aggregating so that we have access to meaningful scale so we can have these, larger deployment conversations. And if you've got granular scale for a few thousand sites, it all adds up.
Hello and welcome to Cool Vector. I'm David Snow, your host. And today we're joined by Omar Jaffrey of Palistar Capital.
Thank you, David. Thank you for having me. Really excited to be here.
So Omar, your firm, Palistar Capital, is a specialist in digital infrastructure. As you think about the future and sort of the opportunity that is unfolding, what kind of makes you feel most bullish? If you think about a mega trend or a statistic that you're following and say, I'm really excited to be in digital infrastructure today, what would that be?
So I think the data consumption is still growing at 30% a year. And it's growing globally at 30% a year. And that pull-through is in wireless, that pull-through is in broadband, and that pull-through is in data centers because you have to manipulate, use, curate that data and bring it back. And there's these leapfrogging elements that make us use more data. So doing these video chats on your phone. Now with AI, we're doing all this stuff, and Apple and Samsung are building AI into the phone. Well, that actually has to go and get things. So data consumption and usage, I think, is the biggest tell on where digital infrastructure is going. And that is at least another decade-long opportunity set, especially with the AI evolution, cloud evolution that we're experiencing live, 5G evolution, and we're now scratching at 6G, just so we can do more things as we move around and we work and school and consume entertainment in different locations.
A couple of years ago, you raised a nearly $2 billion fund. You invest in all kinds of digital infrastructure, including, fiber optic networks and towers and data centers, and we're going to learn about all that. But first of all, why don't we just start out with a bit of a 1,000-foot view on what your investment activities look like now. We all know that the world needs a lot more digital infrastructure. Digital infrastructure is going to require a ton of capital. You have capital. What's it like out there for you sourcing opportunities? Are you seeing the kinds of opportunities that you expected?
So I've been in this ecosystem for almost 40 years, going back to the late 1980s. And I would say presently is probably the biggest delta in demand for these kinds of assets. And on the other side, supply and financing for these kinds of assets. Data consumption and the overlay of AI has literally stripped away any particular corporate's ability to fund. The trends in the three main areas of wireless, broadband, and data centers are just tremendous. And as an investor in it, we are looking for opportunities to partner. So we partner with corporates, we partner with other investors, GPs, and then we create on our own. But the need is in the hundreds and hundreds of billions of dollars in every one of those verticals. There's just not enough capital. So enormous opportunity to partner. The capital requirements are outstripping the availability of capital of corporates. And that's where financial partners like myself are very valuable actors in this ecosystem.
We know that the rise of digital infrastructure is seen as a huge opportunity to connect institutional capital with these digital infrastructure projects. And so there's a demand, or at least, as you would know best, a huge interest in deploying capital into these kinds of assets. In 2022, Palistar raised a $1.9 billion digital infrastructure fund. as you were connecting with investors for that fund, what kinds of questions did they have for you? How would you characterize their interest and their understanding of this asset class?
We actually were in a really interesting time. We started raising our fund probably 6 months before COVID. Prior to COVID, the questions I used to get asked is, why should I invest in digital infrastructure? I've got all these great airports and ports and toll roads around the world. They are concessions by government, very stable, lots of opportunities. This feels very techy. Why should I do this? And I think what folks realize, investor community realized, is everything in infrastructure was correlated except digital infrastructure. We saw ports shut down. We saw nobody using roads. We saw airports basically go vacant, vessels and transport. So what you normally thought of as a very stable sector of investments all choked up. The output of that was investors reflected on actually how correlated general infrastructure was to GDP and local economy, and how uncorrelated and growth opportunity digital offered. So following 2021, generally speaking, investors wanted exposure to two incremental things. One was energy conversion, and the other one was digital infra. So we benefited from that. It highlighted that there are parties around the world that just don't have connectivity and they're being disenfranchised. So it actually became a opportunity to even check the ESG box, which is if you invest in digital infrastructure, you're connecting the unconnected. So I would say there was a fundamental shift due to COVID of understanding this ecosystem and how valuable it was. And it's never stopped since. The question stopped on why digital infrastructure and got into how are you investing in it and how are you going to deliver for me better returns than the alternatives.
It's interesting you say that, pre-COVID, people were a little hesitant because of the technology profile of digital infrastructure.
Yes.
But is there any trace element of validity to that? I mean, you're dealing in assets that are technology-based, and I think people are probably worried about obsolescence. Maybe they invest in something and then, 10 years later, people aren't even using that kind of technology. How do you get your arms around the long-term viability of these investments and the predictable revenue?
100%. So what makes digital infrastructure a little more complicated than buying a toll road per se? This is partly why generalist infrastructure funds struggle as they sort of lean into this digital infrastructure ecosystem. This is where I've lived for 40 years. I've seen all the cycles. We understand it. If I took apart wireless as an example, is Verizon an infrastructure company? But I would submit that Verizon is not an infrastructure company. It uses infrastructure assets. What assets does it use? It uses wireless towers. It uses spectrum. So those are actually really powerful hard assets that underpin how wireless companies provide connectivity. If you can strip out that layer and invest in it, uber durable. It is the highest priority cash flow that is paid by the carriers. Longevity of the assets are 90 years with almost no drama, no churn, super long cash flow, escalators, inflation hedge. That, to me, the wireless infrastructure part, which is the hard assets that enable wireless connectivity, are what's the infrastructure part, and that's super stable. But people didn't fully appreciate that. Is Comcast an infrastructure company, or is the broadband that it's laying down the infrastructure? I would submit it's the broadband that it's laying down as the infrastructure. And this is where some investors make the mistake of buying the entire vertical stack, where then you're buying the human capital, you're buying innovation, you're buying IP, you're buying customers, you're buying churn versus the infra layer. And same thing in data centers. You can go all the way up into kind of the AI element of the software stack, or you can provide the sort of picks and shovels. So in digital infrastructure, it's a little more complicated because you could accidentally step into the actual service side of it versus the picks and shovels. And I think that's where people tend to get confused about it. And we focus very hard on the infrastructure picks and shovel layers, and it's just massive. And if you do that, then you're inoculated from a lot of the technology layers and other elements and evolutions, and you benefit from that dynamic.
Can you give an example of perhaps someone making an investment in a digital infrastructure asset and getting more sort of operational risk than they bargained for? Is it like you invest in a data center expecting more of an infrastructure experience, and then you confront, as you put it, kind of the human capital complexities of running a data center?
So 100%. So there are companies out there, and they're actually a little more challenged. They would claim they're data center companies. If you look at their website, they'll say they have 40 data centers. But when you kind of really double click on it, where they make their money is providing services. They provide connectivity, they provide security, they provide compute services, and they don't actually physically own the data center. They lease the data center. But who owns the data center? The guy who owns the data center, in my opinion, is the data center entity. They're making long-term leases, stable 10, 15-year contracts. And so that particular company chose to monetize their hard assets and lease them. So that's now purely a services company, not a hard assets company. And there are companies like that. And their margins shrink because the margin on services is lower than the margin on hard assets. And that's probably a good example of, if you don't understand the layers of data center, you can end up investing in the services element when you are really looking to invest in hard assets. And the same exactly is true in broadband. You can end up investing in the services layer of broadband versus the hard assets element of broadband. So if my asset is irrelevant and the CEO's execution strategy is what's critical, that's a very different business. So JFK Airport is an example. It works because it's JFK Airport and there's no airport right next to it. And so it's hard to muck it up because the airport is the asset and the concession is the asset. If you apply that theme to other areas, you can very quickly figure out, where is it that the asset is not as relevant as the management team is. That to me is more private equity and growth equity mindset investing than where the asset is critical. So what we do is we invest in the assets. We invest in the assets of the data center, invest in the assets in broadband, invest in the assets in wireless, and management teams are really important, but the assets are the critical function.
I want to ask you about a couple of themes that I know your firm prioritizes: decentralization and densification. Can you give us a succinct, brief overview of what that means?
So decentralization, I think, if you look at your wireless business as an example, it exists on 200,000 unique locations in the United States, all over the country, incredibly well decentralized. They're owned by various individuals out there. Data centers were much more consolidated. They were much more consolidated in Virginia, as an example, when we started, because that's where the fiber was, that's where the compute was. It's like building a big shopping mall. All the other retail stores want to come to the same shopping mall. And that's been actually getting decentralized. It's been moving to other cities, major metropolitans around the world, secondary cities. So that's been happening in data center. It has happened in wireless, and it has happened in broadband. Densification is critical in the sense that you need more in the same place because customers are using more. So if you look at New York City as an example, you could have a wireless hotspot over here and a wireless hotspot over here, but both of these are congested and customers are getting a poor experience. You're going to build one in the middle.
So are you focused mainly on building new assets, or do you also acquire, let's use towers as an example?
We try to find the best risk-adjusted return, David. We created our own internal platform that we call Symphony Wireless. We built this from scratch. There's 60 people there. We know where all of these 200,000 locations are, and many of them are owned by individuals. And so part of our opportunity is to go knock on that door and see if we can purchase that from the individual and get some scale. What's the benefit of getting scale? The benefit of getting scale is then we can offer those to our customers like AT&T, Verizon, T-Mobile, and it makes it easier for them than to go deal with thousands and thousands of individual locations. And that we can do at a pretty meaningful arbitrage and strong returns. So we're the largest aggregator of individual wireless assets in the United States today. There's a huge opportunity, $50 billion plus, to go get one at a time, and we're doing that. So that's one strategy of aggregating, operationalizing, and scaling up. We're also the largest builder of new 5G wireless locations in the United States. We've positioned ourselves as a partner of choice. We are working on a build of a fiber platform in partnership with an investment grade telecom operator that wants to upgrade their homes to fiber. So in that case, we would be building it jointly with them, for their use, and getting a good offtake. We also provide structured solutions. So if we don't think owning an asset and controlling it is the right answer, we're actually happy to work with partners who own the equity to help them fully fund their business. So we are a partnership-oriented investor. There has to be some connectivity with the counterparty where they choose to work with us. That's basically in our DNA.
When it comes to the individual owners of towers in the U.S.,
Yes.
what are the dynamics around convincing them to part with their asset? Are they getting a lot of people trying to convince them to sell? Are they surprised when you show up and knock on their door?
So in New York City, as an example, you won't see any towers. In New York City, the wireless infrastructure sits on buildings. And so we knock on those doors, and a lot of folks like their cash flow and they don't want to monetize. Others have needs for capital. Last year, as an example, our team made 300,000 phone calls, right? Just the sheer volume of knocking on doors. And we close a couple $100 million of deals a year.
U.S. office buildings, many of them are under a lot of pressure now. Is that increasing their appetite to part with assets like rooftop digital infrastructure?
Yes, I think, the motivations to sell has to be triggered by something. So either they have capital investment needs in the building, or they're just trying to pay down some of their debt. It has to be triggered by some capital need, especially when interest rates are higher, right? Imagine you have floating rate debt, so your cost of debt is higher. Your cash flows are more squeezed. Also, life events. A lot of these buildings are owned by families, smaller businesses. Ideally, we've had conversations with them multiple times before then, and they know us versus sort of just-in-time type of M&A. Most of these things have a lot of years of work going into them.
And with regard to building new towers in partnership with another group where they say, hey, could you build a tower in this place? What would make you say, no, this is not the right kind of a place for a tower?
Part of the challenge is zoning and permitting. This is a real estate business at the end of the day. So do we think we can get the zoning rights and permitting to build in that location? And there's I think, a much better understanding today of how important wireless infrastructure is, but there's definitely a NIMBY element, not in my backyard element. How difficult is it? Some jurisdictions, believe it or not, still are challenging on zoning and permitting. So that's the first cut. I think the second cut is for that topography, for that area, do we have easy access? Is this on top of a mountain? So I gotta build a 2-mile road to get up there. That's a problem. Third would be sort of environmental issues. So if it can check those 3 boxes, which is we can get zoning and permitting, logistically and topographically, it's easier. There's no environmental matters. Then it's a good place to build, especially if the need is coming from a strategic player who says, this is a priority for me. So if a carrier is saying, hey, I got a problem here, that means others must also have a problem. So for us, that's a good filter to say, if we build it here for customer A, over time, we believe customer B will join and customer C will join, and we'll see improvements in our cash flow.
Thank you. Well, I have a question about it. Mobile backhaul. What is mobile backhaul, and what do the trends within mobile backhaul indicate about the opportunity for digital infrastructure?
So mobile backhaul generally refers to your phone connecting via spectrum to a location, and then at that point, dropping it to the ground and then using some version of physical connectivity. Years and years ago, you had an antenna facing your phone, and then you had a microwave dish facing the other direction to connect to the main hub. So more and more, that backhaul is becoming fiberized. It used to be copper cables, used to be cable, and more of it is now fiber to get multi-gigabits, 10 gigabit type higher speeds. Because the more obviously you're putting spectrum on, the more customers you're serving, the more backhaul you need for connectivity and lower latency. And so a lot of investments are going on now in making that backhaul infrastructure more resilient, redundant, broader, and lower latency.
Omar, you mentioned NIMBY, not in my backyard. Is it safe to say that, municipal or regulatory resistance to building is more pronounced on the data center side than on the wireless tower side?
I think it's evolving, honestly, David. I think today there's a very large recognition, even in the wireless side, that wireless connectivity, broadband connectivity is a social good. The federal government spent almost $20 billion on something called FirstNet to harden the network, because when hurricanes hit, most of the infrastructure is gone and you got to get it back up really quickly. And that's the best way is wirelessly. So there's a lot of recognition at the municipality level that these types of things are actually social good, are important for economic growth and welfare. I think on the data center side, it's not so much zoning and permitting is challenging. It's availability of power, availability of real estate, and availability of broadband in scale is limited. Today, the data centers are getting bigger and bigger for AI. And where are you going to locate them? How are you going to get them powered up? How do you ration power? How do you forecast power 10 years out in which jurisdiction? Those are becoming really critical issues. The volume of what you need for zoning and permitting is quite different in data centers versus wireless.
Question for you about deployment of capital. One risk within institutional investment is that, sure, you can allocate, it's called $1 billion to a strategy, but if the managers in charge of putting that capital to work are unable to deploy it in the agreed upon time frame, then it just doesn't perform as expected. Is that a risk within digital infrastructure, that you raise some capital and you want to put it in data centers and fiber and wireless towers, but for all kinds of reasons, topographical, regulatory, you're unable to put it to work in the time frame that you expected?
I've not seen that problem, honestly, David. We fully invested our first fund that we raised $700 million in 18 months. We had originally 4 or 5 years to do it. We did it in 18 months. We raised our second fund in the middle of COVID. We ultimately raised a lot more than we had originally anticipated, but we've now almost fully deployed it in less than 3 years, right? Normally we've got about 5 years to invest. And we have looked at a ton of stuff and said, no, we right now have probably a very actionable $10 billion pipeline. If we were much, much, much bigger than what we are, where we're fully conscious, we can deploy well, sort of inside 3 years, and not just write checks, but asset manage and have a good exit strategy in the back end and deliver strong returns. At $20 billion scale, if you had a fund like that, I think then you'd feel a little more pressure, because you got to find these unique, interesting opportunities. We purposely have smaller funds so that we can invest wisely and quickly and have it deployed and start trying to drive the value.
Digital infrastructure as an asset class has rapidly left its former status as being a niche asset class. It's becoming a major sort of standalone asset class. And so capital is coming in.
Yes.
How do you predict the increased competition will show itself as more capital comes in?
So I'll give you a perfect example. In our Fund 1, when we created it in 2014, we might have accidentally been the first digital infrastructure fund. And this word wasn't even used. It wasn't digital infrastructure. And we said, look, these are such high quality assets that if you are a secured fixed income player, you'll understand this and you'll want this because it's durable and long lasting. We think insurance money that needs to map long duration liabilities with long duration assets that are inflation hedged will like this. We think these are REITs and real estate centric assets, or real estate people might like this, want to go into digital real estate. This ecosystem checks all those boxes. It checks the insurance box, it checks the pension box, it checks infrastructure box, it checks real estate boxes. And lots of folks want to buy assets that have durable returns in scale. And so what are we doing? We're trying to arbitrage that by creating those scales, right? Buying things one at a time. I put 1,000 of them together, I've got some scale. I put 2,000 of them together, I got some scale. I build them one at a time, I get some scale. So we're trying to create that bouquet for the larger players. And there's literally probably 100 potential buyers out there interested in this type of asset class who don't have the ground game and access that we do as a specialist. It's just an incredibly exciting environment, even so much so that I would say other GPs who are not in our ecosystem are considering sort of expanding into the ecosystem by investing in our area. So you may have seen Blue Owl buying IPI as an example, which is a very specific data center company. Blue Owl is a large aggregator of assets. So definitely that element of our business is evolving as well, as larger players are looking to figure out how to fill in the gaps on digital infrastructure. And those are some really, really important conversations to have, is how do we all partner together? Inside this ecosystem of alternative asset investment, there are folks that are kind of leading and investing, and then there's others that have a lot of capital and LP relationships that are trying to figure it out. And it's just a very vibrant environment to be discussing this ecosystem.
And does it remain relatively friendly? I mean, has it reached the cutthroat point yet, or is everyone trying to work with each other?
Yeah, it's pretty fun. I mean, there's a lot to go do, and there's a lot of opportunities to partner. I think folks have realized it's a pretty big ecosystem. Whether we're partnering with corporates or, we just did a transaction partnering with another GP. We're working on another one. We're working on some corporate partnerships. So you have to take that approach. So there's just a lot of vibrant dialogue within the space.
Under what circumstances would Palistar Capital build a new data center? Is that something that you would consider, or is that for someone else to do?
We've considered it quite a bit. To me, finding the right location and power is critical. Finding an anchor customer that's willing to backstop that contract. What we're not super comfortable doing is a sort of wildcatting, just kind of finding a piece of land, hoping I get some power, hoping I get broadband, hoping I get customers. There are people who do that. This sort of classically real estate thing. I've bought a piece of land, I'm going to go build a building, and then I'm going to see if I can sell the apartments, or I'm going to see if I can lease up my office space. So we are reluctant to do that, but it's just not in our DNA. Thousands of them. Right now, we own about 5,000 wireless locations around the U.S. You may have heard of edge data centers. It hasn't really picked up full deployment speed, but you can imagine as cars are more connected, it's easier for a small data center to be at that tower location to speak very quickly to that vehicle versus it going back to New Jersey and then coming back to that location. So you're going to see over time data centers sort of move more towards the edge. And we ultimately own the edgiest of edge assets because we're the ones where it goes wireless. So we're very actively watching that and seeing how can we enable the land that we own on these tower locations.
So you're saying that if you own the land under a tower, you have upside optionality to perhaps add assets to that footprint? Can you talk a bit more about that and how you think about the possible upside?
Yeah, so traditionally, a tower sits on a block of land and the tower leases that land from somebody. It could be a municipality. It could have been a contract they signed 30 years ago. A muni has a contract on 3rd and Main, and on that sits a tower. Tower guy's paying rent and all good. Well, as technologies advance, there are several things you can do. You can bring backup power and lease it to the carrier, and all of a sudden you got an income stream. You can put in green power. There's actually miniaturized solar, miniaturized wind, believe it or not. You can bring batteries to become redundancy. So now you got another revenue stream from that land location. You can actually put some edge compute there, a little box, and folks have been testing the little box. The question right now is really, what content and smarts are you going to put on that box versus the big box you've got that you spent $500 million in that data center? What's going to go in that little box? So that one's still being worked on. Now, just having one piece of land isn't going to help you, right? Because there's 200,000 locations, how are you going to get any attention from that one piece of land? So having a meaningful network and a meaningful critical mass so that you can actually help in deployment is important. So that's partly what we're doing, is we're aggregating so that we have access to meaningful scale so we can have these, larger deployment conversations. And if you've got granular scale for a few thousand sites, it all adds up. So that's where we are spending some time and doing some R&D with our partners on what's important to them. We're trying to map what we think is the art of the possible with what is practical for our customers. And that's the gap between a return on investment that's sooner versus a return on investment that's longer duration.
As you think about the supply chain of all the things that are necessary to build out digital infrastructure, are there any materials or natural resources that you're a little worried there simply aren't going to be enough of, or if there's a shortage of them, it might slow the whole train down?
Great question. I think each of the sub-verticals probably has a slightly different answer. In wireless, the choke point is spectrum. Right? So spectrum, the world ran out of true wireless spectrum a few years ago. You saw governments go to satellite companies and say, give me some of your spectrum back. And that was called the C-band spectrum. And companies in the US spent almost $100 billion on that type of spectrum. And the derivative of the choke point is the more choke point you have, the more points you need to kind of divvy up what you have. So as asset owners, we're the beneficiary. If you have more spectrum, you're going to use it more on my current location. So I'll see the benefit of that. But the less you have, the more you're going to want to diversify and densify your network. That's the front end choke point. On the other end now, really bizarrely, availability of power is a choke point because AI came so fast and the need is so massive. It's just multiple times what's available in a community that in certain communities, it's beginning to squeeze out homes and businesses. So legislature and local folks have to think hard about, do I permit this data center and give it its power from the grid? How do I then satisfy the rest of the businesses that need it? Solar, as an example, works during the day, doesn't work at night. Wind works when it's windy and doesn't work otherwise. So those are episodic solutions. They're not evergreen solutions. So you now have to rethink, how do I think about supplying power? And then the other elements of supply chain are things that connect to that. So transformers. There's a 4-year wait list on transformers today. You never had a wait list on transformers. Transformers connect the grid, cleaning and making the power available across the data center. So folks have to be more creative and go to the secondary and tertiary suppliers of transformers. And you're seeing that in massive scale in NVIDIA. Chips, just no more chips. So you got to have a supply. You have a waiting list on chips. So things that you didn't imagine were going to be the choke points are the choke points. But that's just because the demand has so dramatically outstripped the supply. That's very bullish for folks that actually have access to capital and have access to customers and have access to location. The final is actually the availability of capital. There's not an infinite amount of capital. LPs who fund firms like us haven't seen a lot of M&A activity, so they haven't seen a lot of return of capital. Those are what I would say is on wireless spectrum, on data centers, it's power and some critical elements. And ultimately for all of this is a supply of capital.
When an LP allocates to your fund,
yes,
where does that allocation come from? In institutional investment, people like to talk about buckets. So, you've got your infrastructure bucket, fixed income, real estate. Digital infrastructure, if a large institution didn't previously have an allocation specifically to digital infrastructure, where are they pulling it from?
That's a great question. So, I've been raising capital now for almost a decade. And I have to say, in earlier conversations, it was lost. Folks didn't know where to put us. There used to be private equity and there was credit. Or those were the two original things. And then infrastructure sort of started squeezing in as a derivative of credit. Because what is it? It's secured, it's credit-like, long duration. So it kind of came from that window. Private equity is what years ago used to own data centers. Years ago used to own fiber. And now as infrastructure has become a bigger class, certain LPs have developed a real assets area. So real assets being real estate. And if I own, fiber plants, real estate, I own wireless locations, it's real estate, I own data centers, real estate. So I think the easiest place for it to come from is the real assets bucket inside allocators. And then if they don't truly have a real assets bucket, it's generally called real estate.
Well, Omar Jaffrey from Palistar Capital, thank you so much for being on Cool Vector today, and I hope I can invite you back to a future episode.
Thank you, David. That was great. Thank you. Lots of fun. Thank you so much.